So I suspect, excuse me, I suspect that you've all heard about the so-called gig economy. You may well be taking Ubers, having your food delivered, and possibly having taskers help out with your chores. Jobs such as these actually aren't all that different to the types of jobs that people have been doing for decades. But new technologies have made it easier for individuals basically selling their services through one-person companies to be matched with customers. And if we look at the most recent data, one of the most notable trends we've seen in the labour market has been this move towards individuals working for their own businesses. Now, just a quick word on terminology before I explain this chart to you. People working for their own businesses can be either self-employed, so that is working for an unincorporated business, or they can be working for an incorporated business or a company, and we'll call those company owner-managers. And company owner-managers, self-employed, and employment are the three main ways, the three legal forms, through which you can sell your labour to the market. Now back to this chart. The total line here shows you the total cumulative changes in the workforce since 2008. And if we take a look at the most recent period at the end of 2016, what this graph is showing you is that 39% of the growth since 2008 has come from individuals working for their own businesses. What the dark green chunk of that bar shows you is that most of that has been through self-employment. But I think it's also interesting to note that actually the population of company owner-managers has doubled since 2008. Now, at first blush, this seems to line up nicely with the view that the gig economy is becoming more important. But that's certainly not the only story going on here. So for one thing, the population of company owner-managers has been growing faster than employment since at least the 90s. So that's not a particularly new trend. And when we dig down into the industries in which these guys are working, they're not limited to the types of industries we typically think of as being associated with the gig economies. So they're not all, for example, taxi drivers. It's a much broader paced change underway. Now, this obviously focuses on the changes recently. I think it's worth zooming out to a bigger picture and remembering the context is that 85% of the workforce are still employees. The remaining 15% are working for their own business, and this is at the highest level since 1994. But I'd argue that this isn't a radical change in the way we're working, at least not yet. So in the chapter, we go through a variety of other ways in which the labour market is and isn't changing. But what I'm going to focus the rest of my talk on is how the tax system treats the different ways in which we choose to work. Because one of the things that people often don't realise is that the tax system puts a much higher burden on those people who are employees. And to show you that, I'm going to walk you through an example of somebody who's generating £40,000. Now, if that £40,000 is generated by an employee, the income will be taxed under income tax and will get national insurance contributions, or NICs, at both the employee and the employer level. So that income will get a total tax liability of £12,262. If instead that income is earned by a self-employed person, the tax liability drops to just £8,820, and that entire difference is driven by national insurance contributions. The self-employed get lower rates of NICs, and there is no equivalent to employer NICs on that job. Now, for company owner-managers, they're effectively employees of their own company, and they could replicate the first bar in this chart. They could treat themselves as employees. But there's a tax-savvier thing to do, which is to take out a small amount of money from your company in the form of salaries to take advantage of tax-free allowances, but then to take the remainder of the income out of your company in the form of dividends. And if you do that, the income is first taxed at the company level through corporation tax, and then the dividends are taxed at the personal level, and that brings you to a liability of just £7,706. So effectively what these owner-managers can do is they're recharacterising their labour income as capital income, and they're getting lower tax rates as a result. So I mentioned the gig economy and the new technologies, and they may be making it more attractive for individuals to work for their own businesses, but the tax system is also giving people a very strong nudge in that direction. And that's a nudge that's been in the system for a very long time. So here I'm showing you the same overall tax burden on my example £40,000 of income for these three legal forms over time. And the picture I just showed you referred to 2016-17. And what you can actually see is the gap between the tax on employees and owner-managers is at the smallest it's been for quite a while. And that's because last year we increased dividend taxes, which would have brought down the advantage to company owner-managers. But if we look out to the end of the Parliament, that gap's increasing again, and that's driven by the fall in corporation tax rates that we're expecting. And this combination of the gap between the tax liabilities and the growth in the company owner-manager population that I mentioned a couple of slides ago is having a pretty big impact on the public finances. So the OBR estimate that at the end of the Parliament, revenues will be £3.5 billion lower than if the employees and company owner-managed population had grown at the same rate between now and then. And in fact, the numbers I've just shown you probably underestimate the benefits in tax terms of running your own business. There are a number of other advantages that you can get hold of. So for example, you can split your income with a spouse. That's particularly attractive if you have a spouse that has some unused personal allowance. There's also a lot more scope to deduct work-related expenses from your income. You can also there's more scope to avoid or evade tax. We all know the examples of cash-in-hand jobs, but there are various ways you can do that. Just one piece of evidence that points towards that, HMRC estimates that 30% of self-employed tax returns understate the amount of tax due. Now, some of that will be genuine error. Tax is complicated, but that can't explain all of it. If you're a company owner manager, there's something else you can do which might get you a bigger tax advantage. The example I showed you earlier assumed that income was taken out of the company in the same year it was earned. And I said that first that's taxed under corporation tax, then at the personal level the dividends are taxed. Now for income in the higher rate tax band, dividends are taxed at 32.5%. If instead you can retain that income in your company, possibly with an eye to retirement for example, then when the company is later sold, that income accrues as capital gains. And under entrepreneurs relief, which most owner-managers will qualify for, that income is taxed at just 10%. Now, of course, not everyone's going to be able to retain large sums of income in their company, but for those who can, that's a tax advantage that might be worth waiting for. Now, in the chapter, we set out various pieces of evidence to show that people not only understand the incentives created by the tax system, but they respond quite sharply to them. This is just one of my favourite pictures. This is showing you incorporations per week. And you can see the upward trend that I was referring to earlier. This blue line shows you the point at which the government thought it would be a good idea to introduce a 0% starting rate of corporation tax. That sharply increased the incentive to incorporate, and as predicted, people did more incorporation. The other funny humps in this picture are similarly responses to policy changes. So we know that these tax differentials exist and that people respond to them, but why is that a problem? Now, if you're in the audience or you're watching us online and you are a company owner manager or a self-employed person, you might be feeling quite happy right now. And more broadly, we're used to thinking of these tax breaks as a good thing, as a positive part of the system. But of course, if you're an employee, like 85% of the workforce are, you might be feeling less chipper. Because of course, the flip side of these low rates for one group can equally be seen as a tax penalty for employees. And this really gets at the heart of one of the reasons why these differentials are a problem. Similar individuals doing similar work and earning similar income get taxed very differently. And I suspect we could all agree that that's just unfair. The differences are also a problem because they distort individuals' choices. So there'll be some people out there who might have chosen to be an employee, but are now operating through self-employment, for example, because the tax system has nudged them in that direction. And these boundaries that we've put in place in the tax system create all sorts of opportunities and require a whole raft of complicated rules to try to police them. Now, of course, I just emphasised that the treatment for very similar people can be very different. There are, of course, genuine differences between employees, the self-employed, and company owner-managers. But what I'm going to do now is run through three of the most common arguments as to why they should have lower tax rates, and argue that those arguments can't justify the current tax treatment. So argument number one. Argument number one says that the self-employed should get lower rates, especially for national insurance contributions, because they have lower entitlement to publicly funded benefits. Now, in principle, lower entitlement to those publicly funded benefits might justify lower rates. But in practice, the self-employed get very, very similar benefits to employees. The example that people often point to is pensions, but from April last year, both employees and self-employed are accruing the same rights to a single-tier state pension. There is no longer any difference in the pension rights they're accruing. There are only two benefits that are publicly funded that now the employed get that the self-employed don't. They are statutory maternity pay and contribution-based job seekers allowance. In revenue terms, they are very small policies, and they are certainly far too small to justify the really quite large NICS advantage that is given to the self-employed. So the HMRC estimate that the cost of giving lower NICs to the self-employed this year is £5.1 billion. That's the equivalent of £1,240 for every self-employed person, and that's a cost we bear every year. That's particularly surprising given that self-employed NICs actually only raises us £3 billion. So the self-employed are paying less than 40% of the NICs that they would pay if they were treated on the same basis as employees. I think the important question this raises is, if the government is willing to give us £5 billion break from NICs, why shouldn't that be shared equally between employees and the self-employed? So that was argument number one. This is argument number two. This one's a bit tricky, but stick with me. Argument number two says that the self-employed don't get employment rights and therefore they deserve lower rates. So it's true, the self-employed don't get employment rights, such as holiday pay, sick pay. And the concern is that the government is therefore distorting the market and making employment more attractive to employees, and that we should give them a higher tax rate to employees to offset the benefits associated with those employment rights. And that's a very enticing sounding argument, but it misses a really fundamentally important point, which is that employment rights, yes, they affect the incentives of the employees, they also at the very same time affect the incentives of the employers. So we might also worry that employment rights are making employment less attractive to employers. Employers are now more likely to want to go to contract with a self-employed person. So on the one hand, employment rights making employment more attractive to the employee, higher taxes could be seen as offsetting this, but at the very same time, those same employment rights are making employment less attractive to the employer, and the higher tax rate is reinforcing that problem on that side of the market. The broad point here is that unlike publicly funded benefits we discussed a second ago, these aren't a benefit that the government is giving to employees. They are a benefit, or they're a right, that's being transferred between employers and their employees. It's a transfer between employment, within the employment status. Since there is no net benefit being given to employment, there is nothing for the tax system to offset. So the final argument is that lower rates can be justified as a way to boost entrepreneurship. So just a few points I'll highlight here. The first is that the difficulty and risk associated with entrepreneurship do not in themselves justify a tax break. If the market returns for such activity aren't sufficiently high, there's a good chance they just simply shouldn't be happening. We don't want the tax system to be encouraging bad risks. The real question we should be asking ourselves is the market failing to produce enough entrepreneurship? And the answer is probably yes. But in that case, what we should do is look to why the market is failing and target policies at those problems. Instead, what we do is give these across-the-board lower rates to various groups that are very poorly targeted. Most of the people who are benefiting are doing perfectly respectable things, but they didn't need a tax break to make them do it. And there's no evidence that those individuals who can arrange their activity in order to get the lowest rates are also the ones who are most entrepreneurial. And of course, even if we can think of benefits from the system of lower rates we have currently, those benefits have to be weighed up against the costs that we create by having all these little boundaries in the tax system. So there's one issue that I've been sort of parking to one side so far, and that's that the self-employed and owner managers differ in an important way from employees in that their income reflects the return to both capital and labour. So I said right at the start that you can get yourself some lower tax rates if you can recharacterise your labour income as capital income. But of course, some of these people do genuinely have income which reflects the return to capital. And we absolutely should not distort investment. The tax system should not do that. And therefore, we do want to treat investment differently. But the way the UK goes about this, and most other countries do the same thing, is to try to use lower rates on the return to capital, including on the returns to the self-employed and company owner managers. And this creates a really horrible trade-off. So on the one hand, we reduce rates to reduce the distortion on capital, but then once we've reduced the rates, we increase the incentive to convert labour income into capital income. And this just plays out through all sorts of policies. So here's one example for the UK. This shows you the capital gains schedule for just one type of assets. And you can see it's gone, since 2000 it's come down, then gone up again, there's been a new relief, it's come down again. And this isn't simply reflecting the political preferences of various chancellors. It's reflecting exactly this trade-off. We have rates high, we worry about the distortion, so we put them low, we worry about the avoidance, we put them high, and so on, you see the point. But there's good news for this Chancellor and for all the Chancellors to come, which is that we don't have to keep going on this ride. There is just simply a much better way to remove the distortion to investment, and it's to adjust the tax base. We should just make sure that the money invested in a business is fully tax deductible. Now, there are various ways to do that, and we highlight those in the chapter. But for now, in a nutshell, what that really means is that a break-even investment, an investment that just about covers its costs, wouldn't get any tax, and therefore the tax system wouldn't be distorting the decision over whether to do that investment or not. Highly profitable investments would get taxed, but they'd still be profitable, and they would still happen. So by adjusting the tax base, we can take the distortion off of investment and then not have to worry about this trade-off with high rates. And that's one part of what we think of as a bigger picture solution about how to deal with the tax system in this area. The other part is to align rates at the margin, by which I mean, regardless of whether you're an employee, a self-employed person, or a company owner manager, and regardless of whether your income accrues in the form of salary or capital gains or dividends, each marginal pound you earn should be taxed in the same way. Now, there are various ways to do this too, but broadly you could think about it as aligning the national insurance contributions of the self-employed with the combined employee and employer NICs. And to align, so make sure that you tax dividend income and capital gains under the same rate schedule as earned income, also including NICs, and after accounting for any corporation tax paid. Now, that's a fairly radical change from where we are now. But the beauty of it is that it treats the tax system for what it is, a system. And it differs from the current approach, which tends to be sort of the policy equivalent of whack-a-mole. We pick one specific area, and we sort this one out, and then another problem pops up over here. And only by thinking about the system as a whole can we stop that game. So in summary, I've shown you that there are large tax differences across legal forms, and that's unfair and economically inefficient. The differences can't be justified by the now very small differences in public benefits or by arguments related to employment rights. And lower headline rates are simply poorly targeted at boosting entrepreneurship. A comprehensive solution would be radical, but it's worth it because we could move away from the sort of sticking plaster approach. A great first step would be for the government to set out a long-term vision for where it would like the tax system to be, and we could all start working out how we move towards that. And I'll just end by saying there will be losers from a major policy reform. But if we keep the current system, we allow the current inequities to persist. That's another way of saying there are already many losers, and they include most of the workforce. Of course, given the trends I showed you right up front about the move towards individuals working for their own businesses, the longer we wait, the more losers there are going to be. Thank you.